My first speaker today is Philip Liebenberg. Philip, thanks for joining us. Philip's going to be taking us away, discussing some of the inflation issues that are in the market and how he's positioning the Nedgroup Investments Fund. So, Philip, I'm going to hand over to you to carry on.
Doug, thank you. Morning, everyone, and I hope you're all well rested after this quite lovely Easter long weekend. Today I'm gonna share a few thoughts, take you through the flexible income fund, but broadly more just touch on a few points that we're seeing in the market. Well, firstly, we'll have a quick overview of Q1. I think the first quarter for us was slightly more challenging than usual, and if you look at those returns, not ecstatic about the quarterly return of 20 basis points, but over 1 year, a nice 7% return. Now that quarter's return, one or two things we can touch on. A property had a negative return over the quarter, and then we had actually the rand being quite strong over the quarter, and rand strength, does impact some of our offshore holdings. And maybe a bit more interesting point, we do hold some offshore bonds. We had a 70 basis points, that's 0.7% exposure to a Russian social media group called Mail.ru or VK. Now, what is interesting here, we took this smallish position, about a couple of years ago, quite high yield. You've got other investors like Naspers, Tencent, and Alibaba invested in this group. Solid balance sheet, so there's no real credit issues. But as you know, we had Russia invading Ukraine, and at the moment we took that bond was written down to about 25 cents. In the rand, and that's not because of any credit issues, but because of some of the sanctions. So that also impacted our quarterly return. And maybe just for your benefit, as clients, we are in negotiations. This bond has become callable, so we do see quite a bit of upside from current levels. So that's just the quarterly overview, as you can see. Now back to the fund and what we try and achieve in the fund. We follow a diversified alpha approach, and our job is to look at a diverse range of opportunities in the fixed income world. And as you can see there, this will include nominal bonds. We look at the yield curve. Currency is an important one. We look at credit, listed property, convertible bonds, etc. So quite a diverse range of alpha opportunities that we explore. We look at inefficiencies across all of these and then try and identify assets we believe there's good upside, and obviously we want to avoid big drawdowns in the fund. But I think if you look at the last couple of years, having this diversified approach has been, I think, quite important, because you can go in a cycle which we've just seen where you have quite low money market rates. So our goal is to provide clients with a consistent performance above cash over, let's say, a 1 to 2 year horizon. Maybe let's move on to the global backdrop. Fascinating what we're seeing at the moment. We went through COVID. We thought we through the worst of it, and then we had Russia invading Ukraine with a lot of knock-on effects. But let's just first focus on where the US is. As you can see there, if you look at bond yields, this is going back for nearly 40 years. And global bond yields have been exceptionally low, as you know. You look at the US 10-year, which was well below 1%, at the moment 2.5%. This morning, US Treasuries are at 2.8%. But what's more important, if you look at that picture, would be US CPI, 8.5%. And, I thought back and I said, there won't be a lot of investors here today that's actually seen US inflation at these levels. I mean, the last time this occurred was basically, early 80s, late 70s. So I think the one concern for us is, how high can some of these bond yields go, especially if they introduce things like quantitative tightening, where the Fed will have to, lighten their balance sheet. So yeah, high inflation, and high inflation, of course, also causes demand destruction. We don't always think of it, but as prices go up, if your wage growth does not follow, that will lead to demand destruction. So the US, I mean, it'll be fascinating to see how all of this plays out. We have used a bit of this opportunity to add to a few offshore bonds, but our duration on the offshore side is still quite low. On the US, like I said, I think more headwinds than tailwinds at the moment. You can see there the US real GDP forecast. But please bear in mind that nominal GDP is actually quite high, given what you know, where inflation is. But real GDP are slowly coming into focus and slowing down. And if you look at the PPI, the consumer sentiment indicator on the right-hand side, also slowing quite dramatically. So we are seeing the US consumer, despite massive fiscal stimulus and basically, you know, those checks they got into in the mail, is slowly working through the system. There is still quite a high, decent demand on the US side, but I think we will see that slowing down significantly. The Fed, of course, want to slow down the economy to rein in inflation. And as we've said, I think the Fed is unfortunately being behind the curve. They now need to catch up. And I think the last time we looked, they've started raising rates in March. We are now looking at probably at least 50 basis point hike from the Fed in the next meeting. And the markets are also saying, listen, there's a high possibility of another 50 point hike in the next meeting. So the Fed really needs to see if they can rein in inflation. Unfortunately for them, there is still some of the supply chain constraints and issues. So you probably have inflation that's both a demand issue and a supply issue. And to curb inflation without affecting, you know, job growth and full employment will be a tough ask. So I think more and more people are saying, I think the possibility of a recession in the next year to 2 years is quite, the probability has gone up quite considerably the last couple of months. So we can go on a lot about this. I think you know, yeah, I think the scene is set on a global side. Obviously, that'll impact the local side. If you look at our rate expectations, we have started hiking rates. Rates are at 4.25%. The SARB came out on the last MPC meeting being a bit more hawkish, where 2 members said, listen, we think we should hike by 50 basis points. We do, however, think that our yield curve is probably pricing in too many hikes in our curve. So we don't see rates going up as aggressively as the market thinks. If you look at inflation there on the right-hand side, we do, you know, you rewind a couple of months ago prior to, you know, this invasion of Ukraine, which had a big commodity price shock to the market and fueling inflation, energy prices being quite a bit higher. So that is now pushed up inflation to, we see over the next quarter or so peaking, but at above 6% and above, you know, our target range of 3 to 6%. Core inflation is still okay, but as you can imagine, you know, headline inflation, where energy and food plays a big role, is elevated. But in essence, I don't think we have a big inflation problem yet, but the concern remains that we see a bit of a slightly higher expected or unexpected inflation over the medium term. And then, you know, we had our budget, and you can see actually quite a decent budget, and you know, to a large extent, we got bailed out by commodity prices, where we had, you know, revenue overruns, a fiscus that's improved quite a bit the last year or two. We were slightly more conservative in our bond outlook just post-COVID, but with these massive tax overruns on the back of mostly commodities, although the consumers has helped of late as well. This has put our fiscus in a much better position. And that is depicted on the slide on the right-hand side, where you can see in the October 2020 MTBPS, you know, the Treasury was seeing a debt to GDP peaking at 95. Then came the November 21 MTBPS, that fell to below 80. And now we are seeing the peak in our debt to GDP ratio as, you know, just below 75%. So a big improvement. So if you were to see SA as a credit entity, a big improvement in our credit conditions, and from a fiscal side, quite pleasing. I think what we now need to do is follow through on some of these reforms. We have seen the spectrum auction going quite well. This morning I saw we just got upgraded to stage 4 load shedding. So I think on the energy side, a lot of work needs to get done because, imagine the economy actually start growing. The energy sector is definitely, and Eskom is quite a, I think, impediment to if we see any growth. So long story short, I think on the fiscal side, actually going quite well. If we go more to let's look at valuations. If you look at our yield curve, quite a steep yield curve. And we've got a few numbers there on that table. I won't go through all of them. But long story short, our implied risk premium is about 5% on bonds. Our local 10-year bond is just over ballpark 10%. We see that fair value closer to 9, maybe 9.5%. So we do think SA bonds are attractive at these levels. And we used, the last bit of mayhem we saw in Feb, beginning of March of this quarter, we actually increased our duration slightly. But still a nice diversified portfolio. And then lastly, the mighty rand. At the office, we do believe we now the reserve currency of the emerging markets. Maybe we shouldn't go that far. But, the Russian ruble and you look at the Turkish lira has become, for obvious reasons, just about uninvestable to offshore investors. And I think the rand has been a beneficiary of this on the back also of strong commodity prices, current account surplus, good trade balance. So we, at the moment, think the rand is slightly expensive at current levels, but we do believe that when our current account situation becomes more balanced, that you will see slightly more headwinds for the rand. But fantastic performance by the rand. It might also now be a time where you say, okay, how much can I take advantage of this? Because you've got assets offshore that's taken quite a bit of a beating. You look at European shares, and the rand is actually, in a risk-off event, the rand is actually done quite well. So that was just a bit of a backdrop on the portfolio or on some of the way we see markets and a few valuations. I'll quickly touch on the portfolio positioning. You can see they're quite nicely diversified. We do believe in this diversified alpha approach. Look at opportunities when you see them. And volatility is not always good for shorter term returns, but fantastic for us to look for assets where we believe there's some good upside for investors. Current portfolio yield 6.5%, total duration 1.3, of which 0.9 would be SA bonds, 0.3 inflation-linked bonds. Inflation-linked bonds, fantastic diversifier in the current environment. You can see we've got about 12% there, 22% fixed rate bonds. And then we've got about 38 floating rate bonds, which will, as rates go higher, boost the yield of the fund even further. Our effective offshore exposure is only 5.9, let's just call it 6% at this point in time. So nicely diversified. We do have a bit of property in there. Our yield on the offshore component has done exceptionally well. Firstly, there was a bit of a headwind as US rates went higher. At this point in time, our offshore yields are around about 4% and slightly higher. So we got an opportunity to increase our offshore yield. So nicely diversified, I think in good state for the next year. And I think clients should benefit from what we've seen the last couple of months, where we got opportunities to enhance the yield and also we believe enhance future returns. That's it for us today. Thank you for listening and watching.
Thanks, Philip. Appreciate that presentation. We have time for one quick question. You mentioned a lot of inflation pressures coming through, and I wanted to ask you, we have a question come through that just said, how is the flexible income fund positioned to deal with the threat from inflation compared to your average money market fund?
Yeah. I think, Doug, maybe I'll touch on one or two things. So I think if you look at inflation, we do have inflation-linked bonds in the portfolio, about 12%, fantastic diversifier. It will pay you inflation plus a real return. In this case, it's 2.5%. So quite deliberate in that. Our floating rate component, we are getting a return of about 1.5% over money market. So if you see money market with the inflation, hopefully there's a bit of joy on our floating rate component. And then our long bonds, the implied real return on our long bonds are north of 4%. So I think being able to access these types of assets, I think is a nice protection against inflation over the medium term. And I think having the flexible mandate just allows you to access these, hedges. That's, I think, just better in hedging out inflation.
Thanks, Philip. Appreciate that. That's all we have time for today. I did a podcast recently with Philip, chatting through some of the big impacts on fixed income markets, both globally and locally. So please do check it out on our Nedgroup Investments podcast channel. It's about a 15-minute podcast, so go ahead and I hope you enjoy that.